All right, today we're going to talk about something that gets totally lost in all the hype about massive returns. We're going to dive into the real secret to long-term success in pretty much any market, just plain survival. I mean, it's easy to get caught up chasing those huge, flashy wins, right? But here's the thing about compounding. That magic little engine that builds real wealth, it has one rule you just can't break. You have to stay in the game. Simple as that. If you blow up your account, well, there's nothing left to compound, is there? So, what exactly is this risk of ruin? Let's get specific. This isn't just about a bad trade or a rough day. No, this is the tipping point. It's when you take a loss so big, so devastating, that just getting back to where you started feels like climbing Mount Everest. And you know what happens then? That's when the really dangerous stuff kicks in. Revenge trading. That desperate emotional scramble to make it all back, which, let's be honest, almost always makes things way, way worse.
Okay, and you know the drill, but I've got to say it. This is all for educational purposes, all right? This is not financial advice. Digital assets are risky, so you absolutely have to do your own homework, always.
All right, disclaimer out of the way. Let's dig into the heart of the problem. We're going to talk about something called the asymmetry trap. And trust me, it's all about the brutal kind of mind-bending math that happens when you lose money.
So lean in for this next part because this is one of those concepts that once it clicks will completely change the way you think about risk. I'm not kidding. A lot of people unfortunately learn this lesson the hard way.
Just look at that. The difference is just huge. If your portfolio gets cut in half, a 50% drop, you don't just need a 50% gain to get your money back. Nope. You need to double what's left, a full 100% gain, just to get back to zero. Think about that for a second. The hole you dig is always, always harder to climb out of. And as you can see here, it gets so much worse. And it gets worse fast. A 20% loss? You need a 25% gain to recover. Okay, that's annoying, but you can probably do it. A 50% loss needs that 100% gain we just talked about. That's really tough. But that last line, wow. An 80% loss means you need a 400% gain. We're not talking difficult anymore. For most people, that's pretty much game over.
And that right there is the key takeaway. It's why one single massive loss is so much more dangerous than a bunch of small wins are good. Your number one job, before anything else, is to protect yourself from those catastrophic hits. Because you can have the most brilliant strategy in the world, racking up win after win. But if your system has a backdoor that lets one of those monster losses sneak in, poof, all that hard work is gone and then some.
Okay, so now we get the what. We see the dangerous math. But let's shift gears to the how. How does this actually happen? How does a trader get to that point of ruin? You might think you know, but the real answer is probably not what you're expecting. See, here's the thing. Ruin is almost never one single, out-of-the-blue disaster. It's not a lightning strike. It's the totally predictable result of a bad system. It's a chain of small, bad decisions and habits that build up over time, creating a situation where a catastrophe isn't just a possibility, it's practically inevitable. But here's the good news. If it's a system problem, that means it's a problem we can fix. So what's in this recipe for ruin? Well, it's really a cocktail of bad habits. It starts with betting way too big on a single idea. Then you mix in not having a clear I'm wrong point, so the loss just keeps growing. Maybe you're trading in sketchy, low liquidity markets where prices can swing wildly. Then your emotions take over and you start revenge trading. And for the finishing touch, the real nail in the coffin, averaging down on a loser without even stopping to ask if your original idea was garbage to begin with. All right, that was a little grim, I know, but here's where we pivot. Enough with the problem, let's talk about the solution. How do you build a shield to protect yourself from all this? We're going to call it the calm survival model. And the best part? The philosophy here is incredibly simple. You don't need some super complex algorithm or a degree in advanced math. What you need are constraints. Just simple, clear, hard and fast rules that act like guardrails to protect you from, well, yourself, from your worst emotional moments. So, let's lay them out. These are the 6 rules of survival. Rule 1, cap your risk on any single trade. Keep it small, keep it consistent. Rule 2, cap your total risk for the entire day. If you hit that limit, you walk away, period. Rule 3, feeling angry, tilted, emotional, then stay the heck away from assets with thin liquidity. Rule 4, you're never allowed to average down on a loser unless you stop, Take a breath and physically write out an update on why you still believe in the trade. Rule 5. After a big loss, or if you break one of your own rules, you have to take a mandatory cooldown. Just step away from the screen. And finally, Rule 6. You have to track everything. Know your numbers. Make sure your strategy actually works over the long run.
Okay, so we've got the rules. That's great. But let's make this real for a second. It's time for a little self-test, a gut check, to see if you're really prepared.
And I really want you to pause and think about this. Just ask yourself this one question. Imagine you just took 5 losses in a row. It happens. Your system, the one you trust, says it's time to take the 6th trade. What do you do? Do you pull the trigger without a second thought? Or do you start getting nervous, maybe cutting your size? Do you get angry and start blaming the market? Be brutally honest with yourself here. Because if the answer is anything other than yes, I take the trade, if the very idea of 5 losses in a row makes your stomach clench, that's a huge red flag. It tells you one of two things. Either you're trading way too big and those 5 losses would be catastrophic, or your own mental game isn't strong enough to handle normal market randomness. Either way, it means your system is fragile and vulnerable to ruin. And this all leads us to the most important point of all. You can be the smartest analyst out there. You can have the most brilliant strategy ever created. But you know what? None of that means a thing if you don't survive long enough to use it. Your first job, your only job really, is to make sure you're still here to play tomorrow. Because survival isn't just some part of the game, it's the edge that makes every other edge you have possible.